Well, so we want to get a clear understanding of these issues that have been going on at the IFS pre-budget briefing, and I've been joined by my colleague Philip Namfuri, who is going to help us with these education. Philip, a lot more activities going on at the IFS briefing.
Indeed. So yesterday they made a point about governments reducing the participation of foreign investors in the economy, and it's key because when we have these investors coming in, they come in with forex or foreign exchange, and when they are going out of the economy, they take it out. So we looked at just one part of the economy when it comes to debt instruments. So borrowing from the financial markets, how much of it belongs to foreign investors? We have that infographic. Let's let our viewers look at it and we'll continue our discussion.
All right. All right, so that was the total debt rankings in the debt markets. Now, Philip, so 27 billion as it is.
Very high figure. Yeah.
Foreign investors. What does it mean?
Okay, so foreign investors, as of June 2019, hold 30% of the debt in the market, which means that imagine these foreign investors decided to exit the Ghanaian market. 30% of our debt out of 91 billion is being held by these foreign investors. And when they're going back, like we said, they will need a foreign exchange. So imagine them taking all this back. And this is just in the debt market. Can you imagine their stakes in the equity side, in the stock market also? So this is why the IFS and other bodies have been calling for a limitation of this. You know that the government has been promoting local content and trying to get local investors to hold a stake when a foreign entity comes in.
Exactly.
But this is just one part. Imagine 27 billion out of your economy by foreign investors. You can imagine that.
So that means there's a perfect correlation between the level of borrowing as well as the interest rates.
Okay, so this borrowing is both government and the private sector. If you extract the government part out, the 91-day bill, 182-day, and the bonds, you realize that
commercial banks.
Yes, you realize that foreign investors still play a key role in government debt. So how much they lend to government, or how much government borrows from them. And we've heard the finance minister, the governor, mention that the foreign investors indeed, and we saw the ripple effects it had on our economy earlier on in the year when the cedi was tumbling. But you realize that on the borrowing part, when government is looking for funds, there's a squeeze when it comes to the private sector. So because government is virtually risk-free, investors, big investors, convenience to give them their money. There's also another infographic that I put together just to show how banks are rather channeling their funds into these investments rather than to lending. So let's take a look at that.
All right, so this infographic simply means a lot more commercial banks are now putting their monies into buying government instruments and so on and so forth. Why this?
Okay, so we've been discussing non-performing loans as a reason for some of the failures in the banking sector. And banks are in it to maximize their shareholder value and on the side make profit. So if in your quest to make profit, you give a loan to Emmanuel Abajo or George Weafe, and you realize that they will not bring you back all the money you gave them, and you go and give it to government, and at the end of 3 months, 1 year, 2 years, government comes to give back your money, why would you go and lend money to somebody else? So he said that over a course of 3 years, they've reduced their lending from 42% of their assets
to the private sector
to 20%, 20-something%. So you realize that they are giving us less loans and they're giving government more in terms of lending to government through government treasury bills and bonds.
Is it what can be described as crowding out?
Okay, so yes, in that sense, because government also has a dire fiscal need. And we've discussed our fiscal issue last week on PM Express, Business Edition. And we've seen that they need these funds. So where again would they tend to? When they go out for the Eurobonds, there are implications. We need to grow our domestic market, so they are doing it inside. Let's look at one more infographic and you see that banks are moving away from short term to long term. Let's take a look at that one.
Right, so the latest one obviously indicating that banks are now going in for longer term government securities than shorter ones. What exactly is this so?
So you realize that when this government came in, they spoke about reprofiling our debt and lengthening the maturity profile and putting our yield curve back in an upward sloping manner. It was inverted at first. Inverted meaning that there were more short-term borrowing than long-term. Now so government is moving to more long-term. And the banks are also responding from this infographic by cutting their holdings in short term, that's the 91 day, 182 and 1 year, to the long term bonds. And this is what they're doing. So more money for government, less money for you and I, all things being equal.
Thank you very much, Philip Namfuri, for that education there.